Hi, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights, and we're discussing his weekly playbook, which is obviously available on Substack at hugeinsights.substack.com. Jeff, how are you, sir?
I am great, Mehdi. As I mentioned, out of my usual element on the West Coast this week, and really happy to be on the show. So thanks a lot for making this happen.
Hey, you know what? When am I going to get a look on coming out on one of these road trips with you? This is I'm sitting here cold. I want to be on the West Coast. Well, good for you, and thanks for joining us from the West Coast. So it's always nice to step out of your vacation mode. So we thank you for your time. So
Yeah,
Jeff,
pleasure.
so since we last spoke, there's obviously there's still some tensions that certainly raised on a geopolitical basis. There's also some more concerns on the home front in a different bunch of issues. The S&P was down about 3%. It's having a bit of a bounce today as we film. But I'd love to kick off with your top-down views as usual.
Yeah, to your point, we did have a rough week last week. I think probably the most noteworthy aspect of that was the simple fact that the widely observed 200-day moving average was finally penetrated to the downside by the S&P 500. In fact, the S&P closed below its 200-day moving average for the first time since March. I think it's significant. It's a widely watched, kind of bellwether measure of trend, and a breach of that suggests that the market is kind of dancing on the razor's edge with respect to its uptrend. In fact, one of the things I wish I would have put in my note this week, and I forgot to, was that 8 of the 11 S&P GIC sectors are currently trading well below their 200-day moving average. That means 72% of the S&P 500 is in a bear market, okay? 2 of those sectors are trading below their 200-week moving average, and another is on the precipice of challenging that right now. So my suspicion is that everything that we've been witnessing so far is really just the mass investors hiding out in a handful of names that have been dominating the indexes. We know who those names are. We know what their performance has been. No reason to reiterate that today. But at the end of the day, I think this is going to be a critical week for the market, and the reason for that is 4 of those bellwether names: Microsoft, Google, Meta, and Amazon, all report this week. Tonight, it begins with Microsoft, then Google, and Alphabet. I'm sorry, but at the end of the day, if one or both of these names were to falter, if we were to see some news that was inconsistent with expectations are exceptionally high. The estimates are really, the whispers are really high. And so I think any shortfall from any of these 4 companies could really send the markets reeling. Having said that, the opposite is true as well. I mean, one or more of these names posts a massive upside surprise, you could see the market vault higher. That's not to say that we're in a new bull market suddenly because of that. It'd be 1, 2, 3, 4 companies at most that are having that influence. I think the expectations, though, are really exceptionally high, and I'd be very surprised if we see, some earth-shattering upside surprise from any of them. That being said, we've got some other issues, as you pointed out. It's been difficult in Congress for the last couple of weeks without a speaker. We have a potential, geopolitical, catastrophic event on the horizon here. With Israel and the IDF now staging for a significant ground incursion in Gaza. We just don't know what the reaction is going to be throughout the Arab world. That could be, significantly negative if things don't go well. If Israel oversteps, if we could see some hostages, executed. I mean, there's all kinds of crazy things that could happen, and God forbid any of them do. These could all have a negative impact. The flip side would be peace in the Middle East, right? And that would have the opposite effect. And so I think we're really at a decision point here for the market. And the news has been, pretty bleak coming into this point. Rates have moved up. We've touched over 5%. We've backed off of that now. But, as we'll talk about in a second, we think rates are just starting their upside, uptrend move. And so, we think this could move considerably further. and that is not going to have a great impact on stock prices. And so, with that being said, we'll cut off there and just say, we continue to advise our clients to remain patient, to minimize net equity, maximize cash reserves, as we've been saying for months now, and it has been the absolute right advice. It's been the correct positioning since July 27th. And for most stocks, it's been the correct positioning since February 1st. So with that, let's get on with it.
Let's get on with it. So I'm going to pick off right where you started to go down onto some more detail on the rate side. Obviously, rates and yields on the 10-year Treasury are a massive focal point for everyone. So you say you expect them to continue to rise. So talk us through your thoughts here.
Yeah, we titled this chart "Early Days" for the yield uptrend, and I honestly see trend. I see the uptrend in yields as being more structural, not cyclical. And I think that's the mistake that the street is making right now. They're viewing this as a cyclical uptrend in yields, and they think that we're going to come right back down and reverse this trend. But as you can see, we've taken out with authority a 40-year downtrend in yields, which bottomed at around 0.5% on the 10-year Treasury, and we've vaulted through that over the past 3-4 years. And my suspicion is that it's not done with that uptrend. In fact, you've got some issues. Obviously, a lot of supply overhang. You've got debt to GDP ratio now at 122% and growing. You've got a massive deficit. It looks like Congress is trying to push through an 8% budget deficit this year at the fiscal level. My suspicion that won't get through. But you got to have a Speaker of the House first before that happens. At the end of the day, there's no question that the authorities are going to do everything they can to prevent the inevitable from happening. But and that's why I kind of put in the note: prices don't move in a straight line. Okay, they are going to run into resistance levels, and they'll back off to support levels. And so we've kind of illustrated here what we think is that you're going to see the market respond to these prior resistance levels, and hit those levels like a ping pong ball and bounce off them, and then they'll recover back to support levels and bounce higher off of that. And so we see this happening over the next decade. 10 to 12 years is kind of the time horizon that we have in mind. And one of the things that stands out here is the top frame of this chart, where we illustrate structural momentum. This is the 60-month momentum measure. We use an RSI oscillator to illustrate it. And what we're showing here is that in the period of time up until the early 1980s, we were in a bullish momentum regime for yields. Okay, and come around 1982 or so, that broke down into a bearish regime and remained bearish for the last 35 years plus. Well, most recently, about a year ago or so, we saw that momentum break back above the median line into a bullish momentum regime. And it hasn't looked back. And our suspicion is we've got a number of years ahead of us where we're going to remain with a bullish momentum regime. And so if we look at this from a objective lens, we can see yields easily moving up to around 10.5% over the next decade. But it's not going to get there in a straight line. Like I said, our first target objective's 530. And then we think we'll back off and maybe retest the 4.5 range, and then a push up to around 6.5% over the next, say, 18 to 24 months. And then I think, another back off, and then another test of the higher resistance level, which will probably come in around 7.8%. Then backing off again to prior support, then a push up to 9%, a back off to prior support, and then a push up to around 10.5%. Again, over the next 10 to 12 years, this is a massive headwind for stock prices. And that's why we think we're in a structural bear market for bonds and stocks. And this is not going to do much for investors' net worth creation over this period of time.
So higher for longer. Off we go. We've discussed this over the last couple of months a few times. These alligator jaws or crocodile jaws between the skew index and the VIX index, and seeing those kind of converge. Are you seeing this come into play at this point?
Yeah, volatility is it's unpredictable for sure, and it moves in fits and starts, right? And so when we look at option volatility as measured by the VIX, we've seen the VIX. It's been a pretty sustained downtrend for the last year since the October 2022 low, where the VIX had spiked up into the mid 30% range, and from that time we've trended down into say the June, July lows, I think around 13% or so. And we made an attempt to rally off those lows. Those lows were retested in September twice, in fact. We got down to as low as around 12.5%. But since that time, we have rallied aggressively to the upside in terms of the VIX itself. And we've penetrated that downtrend. We've penetrated two resistance levels and actually closed last Friday at around 21.5% or so. Clearly breaking out above that base that's been put in place. Now, I know today we've pulled back a little bit as well, slightly below 20%, as the market is kind of rallying off the recent lows in anticipation of potentially good earnings from two of the big bellwethers, right? Our suspicion is that if we don't get the news that the market is looking for, we could see VIX spike, a surge much, much higher. We think the breakout above 20% counts initially to 26%, but ultimately into the low 30s. 33% would be our target. And Mehdi, I don't think it's going to stop there. I think once we get to that level, we could easily push higher, testing the 40% level and possibly breaking out above that into the mid 40% range or higher. And we haven't printed a number over 40% 2 years or so. I think it's due. I think we're in a situation here where we're ready for a panic. Now, everybody's looking for an October low, but there's still a number of days left in October. So it doesn't have to come in the middle of the month. It doesn't have to come in October. The market has bottomed in November in the past. And so we'll see how it plays out. The cycle composite would suggest that there's more downside ahead.
So it's funny, I say it every time, but we've definitely seen historically some moves in the VIX, which are extremely aggressive, 10, 15, 20, 25%. So, these types of moves are certainly not historically new, so we've got to keep an eye on all this. So you put in an interesting chart on speculation this week. Talk us through this. This is a speculative frenzy hitting an extreme. So, let's go through this one.
We've been looking at different measures of investor sentiment. And, a lot of the survey data, it's pretty skewed. It's widely watched. It's just, I don't think it has the value that it used to have. And it does at extremes, right? At very deep extremes, there's definitely a measure there. But, also the CBOE put call data has been affected by the advent of daily options, right? These 0 days to expiration options has really changed that. And, and the VIX, of course, is already illustrating that, we're seeing a shift off of extreme greed into, now at least a more neutral, if not more a volatile range. I don't think we can really say we're at an extreme in volatility until we get north of 30%. We're nowhere near that right now. But, and continue to try and look at things from a structural perspective. This particular measure, which is been dubbed the speculative to conservative ratio, it was a measure of investor sentiment developed by Peter Elliott of Stock Market Cycles fame. Peter calls it more of a structural measure. What it really does is it measures investors' demand for speculative growth stocks as measured by the NASDAQ 100 compared to conservative dividend paying stocks as measured by the utilities average, the Dow Jones utility average. And so when that ratio is trending to the upside, it shows that demand for speculative growth stocks is dominating demand for conservative dividend paying stocks and vice versa, right? And so the ratio hit a high back in March of 2000 of 16.5 to 1. That level remained unchallenged until 2021, where we pushed above that and rallied to a level of around 18 or so. Most recently, and let me just say that, that came on the heels of the Fed's $9 trillion of policy support, and not just the Federal Reserve, but the Congress, right, pouring $5 trillion in monetary policy and $4+ trillion in fiscal policy support, and that just really goosed the market, and we saw the market take off. But in 2022, we backed off from that extreme substantially and bottomed around October of last year, and since that time, we've rallied back to post a new all-time record extreme last week of 19.1 to 1. I think it just is indicative of the fact that speculative juices are alive and well from a structural perspective. Another great measure that we've talked about in the past is the percentage of households in the U.S. that own equities, okay? And that percentage reached about 63% very recently, which is, the highest it's been since 2000. So, there's definitely a shift, right, toward equity ownership, and speculative stocks versus conservative stocks are dominating that.
Thank you for that, Jeff. So why don't we have a look at some technicals, and you've broken things down quite nicely into like whether it's the Russell or the equal weight S&P. Can you just talk us through like your thoughts on this and some of the levels that you're seeing?
Yeah, so we've done some detailed analysis both on the Russell 2000 and the value line composite. We use the geometric version of the value line composite. It measures the median price change on a daily basis, which we think is apt considering how the market's so bifurcated at this point. But these two patterns, and we've used a couple of different labelings. You can choose which one you prefer. We'll know in the fullness of time which one's correct. But at the end of the day, we think that these are great broad measures of the stock market, not just the S&P 500 cap-weighted index, which is so dominated by the Magnificent Seven. 29% of the market cap of the S&P, is represented by just 7 stocks at this point. And so, when we look at the Russell, it doesn't include those 7 stocks. And in fact, when you X those stocks out, even the broad market looks very similar to this. It just, it topped in February and has never looked back. And we've already broken down below both the 200-day and the 200-week average. In fact, the 200-day moving average is broken below the 200-week moving average. We've broken trend. This is a multi touch point trend line that's been breached. And my suspicion is that the message that we're hearing from the Russell 2000 is that the broad market is anticipating a recession. Now, let's switch to the right-hand side of the chart, and we're looking at the value line composite. This index, again, equally weighted, includes the Magnificent Seven, but it doesn't give them the concentration that the S&P does. In fact, it includes 1,700 stocks. These 1,700 stocks represent 90% of the revenues generated by all publicly traded stocks in the U.S. And I think it's probably the best broad measure of the U.S. stock market. And clearly, another example of how the market topped in February and has not come back to challenge that level. We've broken both the 200-day, the 200-week. The 200-day has broken the 200-week. We've broken a multi-touch point uptrend, and it looks to us as though this is poised to careen lower. Now, we won't know for certain until we take out the October lows of last year, but our position is that we are in the early innings of a third wave decline at primary degree of trend in the broad market. And so these two illustrations confirm that to us.
So, Jeff, can you talk us through the cycle degree Elliott wave analysis on the equal weight S&P? Because it's looking very tenuous here, right?
Yeah. So, again, this chart shows both the cap weight and the equal weight indexes. The difference, of course, is the equal weight simply, puts about 20 basis points of weighting on each of the stocks in the S&P 500, whereas the cap weight puts about 7% on Apple, 7% on Microsoft, 4 or 5% on Alphabet and Amazon, and Nvidia is about 3%. I think Tesla's over 2%, Meta's almost 2%. So, really heavy concentration in those big heavyweight, Magnificent Seven stocks. The cap weight index made a much higher high than the equal weight index. And it fooled a lot of people. It made a lot of people believe that we were breaking out into a new bull market, but we did not see that. We saw that as a counter trend advance. And if we're looking at this from a cycle degree perspective, we think cycle wave 5 of super cycle wave 3 topped in January of 2022. That was the top of a 90-year advance. And we think we're in the early innings of a super cycle degree corrective waveform that, we've only seen one wave down and one wave up at this point. And it's more visible, more evident in the equal weight index, very similar to what we were seeing in the value line and the Russell. We made a high in February, and that was actually slightly exceeded on an intraday basis, but not on a closing basis. And so, that gave us the information we needed to grade this advance as a counter trend advance, because we have subsequently broken down, we've broken trend, and we've broken below that 200-day moving average, and we're now challenging the 200-week moving average. We think that will be the next to break. And if we do get, continued poor earnings results from the vast majority of companies, like I said, 8 of 11 sectors are already trading below their 200-day, and almost 3 of those sectors are below their 200-week. We think we're going to see more sectors breaking down, mostly the cyclical sectors. And these cyclical sectors are pricing in a recession. And we've seen 19 months of lagging data, right, coming since the Fed began raising rates. They began raising rates in March of 2021. And, that is beginning to, show through. I take it back to 2022. Yeah. But the calendar is not in front of me. Apologies. But, the point is that, 19 months have gone by. Typically, it's 12 to 24 months in this lagged effect, right? And so we're about midway between that range, and we're starting to see it impact the broader group of stocks. Now, analyst estimates are very lofty at this point. We are, not particularly confident in those estimates. In fact, I would say we're dubious of those estimates.
So, Jeff, everything's kind of like pointing in the same direction. Let's have a look at the primary degree Elliott wave analysis as well. And one of the things that I'd like to ask you is, what would it take, or what would you like to see to change your views on this as well?
Well, a new high, of course, would be the ultimate, right? If prices in the broad averages, I'm talking about the Russell, the value line, the S&P equal weight, were to take out their February highs, I think it's a different game then. I would change my opinion under those circumstances. I'm not so convinced that the S&P cap weight matters as much right now, because I think those 7 stocks are the defensive stocks of the day, right? The fortress balance sheets, the dependable growth, although we're just not seeing it in all of them. Of course, I've mentioned this many times, but Apple's not growing, and hasn't been growing for the last year. I doubt it will grow when it reports results this quarter, and I think November 2nd. So, we'll see. Maybe the AI plays, Microsoft and Google, still have some growth to them, but we'll find out. If we see a miss from them tonight, it could be game over for the entire market. So that's what I'd have to see to change my mind. What I'm seeing right now is a market that's breaking down, right? And yeah, we're getting a counter trend advance today, a pop, if you will, off of the recent lows last week. That's not unexpected, because markets don't move in a straight line, okay? We get these periodic counter trend advances, and they're usually very sharp to, basically make the weak hands in the market question their positioning, right? I believe the breakdown in the current, count that we have here is still in the very, very early stages of primary wave 3 down. We haven't even completed intermediate wave 1. In fact, based on this count, we are looking at most likely we're in the midst of minor wave. I take it back, minor wave 3 down. So If this carries to new lows, which we think will bottom around, say, 4,050 to 4,100, that comes into play with the 77-day moving average. That's a Fibonacci level that we watch very closely. We think that could mark the end of minor wave 3 down. And that might occur right around the time that a key Montgomery cycle turn date comes into force, and that's around the end of the month. It's specifically October 28th, and this has to do with a lunar eclipse cycle and a Fibonacci time spiral. So those two events coincide. We call it a major turn date, and I think that will mark the low, most likely, based on the count that we're looking at right now. And if it does, that would complete minor wave 3 down, and then we'd expect a counter trend advance. This would correct some of minor wave 3 down, probably something like 1/3 to 2/3. I'd expect it to be on the lower end of that because we're in wave 4. Wave 4 tends to be shallower, usually around a 38.2% retracement. And then I'd expect a final plunge, into minor wave 5, right? A minor wave 5 low would then complete intermediate wave 1 down, a primary wave 3. And that would set us up, if it moves according to the rhythm of the market based on Montgomery turn dates, which the next two following the October dates would be November 13th and November 27th. If we see the market bottom around November 27th, which is consistent with the seasonal, decennial, and presidential cycle composite, right? That comes in with a late November low. Then we should see a year-end rally, which will likely be counter trend in nature, and that will likely count as intermediate wave 2 up of primary wave 3 down. We don't expect primary wave 3 down to bottom until we get down into the mid 2000s on the S&P 500. We're looking for a minimum target of 2775 to terminate primary wave 3 down. And there's a lot of real estate to be covered from where we are today and where that is. Over roughly 1,500 S&P points. And I think that will change the masses' sentiment dramatically about where we are in the cycle and where we are with respect to this bear market.
Well, 1,500 S&P points will certainly change your mindset on things. So, Jeff, looking at the internals, they don't look so good either.
No. part of the reason that we've been as bearish as we've been is we're just seeing a consistent breakdown in the internals of the market, right? This is just the S&P 500, not the broad market. They're way worse if we look at the NYSE data or the NASDAQ composite data. The S&P 500 is kind of like, the house made of bricks, if you will, if we divide the market like the three little pigs, right? The NASDAQ's kind of a house made of straw. The NYSE is a house made of twigs, and the S&P 500 is a house made of bricks. But even the house made of bricks is seeing substantial negative breadth, the worst we've seen really since March of this year. Momentum broke down into oversold, just very slightly into oversold territory. Oversold is the empirical evidence of institutional selling. And then, of course, net advancing volume was ridiculous. It was less than 15% of S&P stocks posted, advancing volume last week. And the ratio between up to down volume on a 5-week moving average basis is about 1 to 1. That's not consistent with a bull market in any way, shape, or form. So, internally, under the hood, the S&P looks like it's in real trouble. Okay. And if we get a breakdown from these 7 stocks that have been the pillars holding up the veneer of the index, even 1 or 2 of them, we've already seen Tesla missed and dropped by 15%. We see another one like Microsoft, and I expect Apple in November. I think the whole pyramid scheme could come tumbling down.
How's investor sentiment setting up?
Well, that's just it, Mehdi. It's not positioned for a bull market. We've already seen sentiment rally back from the lows to an above neutral level. If we're looking at the name exposure index, this is the survey of of professional investors that the National Association of Active Investment Managers takes and compiles every over 2 weeks, we're at 67% equity exposure, net equity exposure by professionals. Okay, that's well above 50%. Which is kind of the low end that you would expect a professional manager to be exposed, and certainly above where we would consider underexposed, down around 30% or so. We got to a point where we were leveraged back in July, so that showed an extreme bearish or bullish sentiment. We got down to around 35% or so. That showed that investors were definitely concerned in September, but now we've rallied back, and there seems to be this massive broad embracing of the notion that we're going to get a seasonal low in October, and nobody wants to miss it. So everybody's back to getting pretty fully invested. Individual investors are a little less enthusiastic. We're at about break even, between the bulls and the bears at this point. I think minus 0.5% is where we are this week, versus plus 3.5. So, we dropped by about 4 percentage points in the bull bear spread rather. But at the end of the day, this is a notoriously bearish cohort to begin with. So I don't put a lot of stock until we get to these big extremes where, we're maybe at 30% bullish and 40% bearish. Those have marked the prior extremes. We're kind of dead center right now. And so it's really very neutral positioning, I think, from a sentiment perspective.
Jeff, let's wrap with having a quick look at sectors as well. You've been promoting, or you've been quite bullish on energy as a sector out of all the gig sectors. It looks like energy is still charging ahead. What are your thoughts here on energy versus other sectors from, like, let's say, a valuation basis and also the relative strength analysis?
Yeah. So first, energy was the best performer last week. There's no question that energy remains the cheapest sector from a valuation perspective. The polar opposite of that would be technology. Tech is extremely overvalued. And in our opinion, it pays and will continue to pay to build in a high margin of safety for your portfolio at this point. And I think by owning, outright undervalued sectors like energy and overweighting those will add alpha to the portfolio. That being said, and I'd also say from a relative strength perspective, energy has been the leader, right? And in fact, continues to be the leader and is one of the 3 sectors that is still well above its 200-day moving average. The other 2 are tech and comm, and that's because they're dominated by the Magnificent Seven, right? I'd also point out that even discretionary, which was the second worst performer last week, is trading below its 200-day moving average. And so, the vast majority of discretionary names, even though it's dominated by Amazon and Tesla, are really faltering. And I think that sector was, one that was kind of, adding some level of confidence to the bull case, because the consumer continued to appear to be strong. The consumer is rolling over. There's no question about that in my mind. And if the consumer continues to roll over, that will take the legs out of the economy. And, we should see that show up in the rest of, the stocks that are continue to holding up, the veneer of the index itself. But to your point, we continue to like energy above all. I would actually be looking at some of the less cyclical spaces, not as an absolute performance opportunity, but as a relative performance opportunity. I think there's a possibility that staples, utilities, maybe even real estate, I'm reticent to suggest that, but these are really, really oversold sectors, and they've really done very poorly from a relative strength perspective. I think if we run into trouble, money could seek out less volatility, and those sectors would stand us out as less volatile. I'd throw healthcare in there as well. Healthcare has actually been doing pretty well from a relative strength perspective, and what did outperform the S&P last week, as did utilities and staples. So I guess that's all I have to say on that.
Well, Jeff, thank you very much for that breakdown. Now, this week you've actually focused on the Magnificent Seven. We won't go into each of these names, but your subscribers can deep dive into your note where you do a technical analysis on each of these names, and you've given us an indication to a degree on your thoughts and concerns around this earnings season as well. So, I would urge everyone to go check that out, and it's obviously available on Substack at hugeinsights.substack.com. Jeff, always appreciate your thoughts and color from Alpha Insights. Thank you very much for sharing it with our viewers.
My pleasure, Mehdi. Great to be here.
Until next time, thank you for watching and good luck investing.